On today's Positively Sloped, a guest co-host in the studio with me is Neil Peplinski, and I take on the Iran conflict and how it's affecting the oil markets before we go ahead and discuss the Fed's dual mandate, both the recent jobs report and inflation data and how that'll affect their meeting next week, before we discuss the AI arms race and what's going on with Anthropic and OpenAI, and wrap up with some March Madness talk. Okay, let's talk shop. Today is Wednesday, March 11th, and welcome to Positively Sloped. We've got a fresh face in the studio today. So Neil Peplinski, portfolio manager of Kingsview, is replacing Scott while he's out of town this week. And Neil, you've got big shoes or big walking boots, should I say, to fill, but I'm confident that you'll be able to do it.
Just so I'm clear, you make this sound kind of temporary, but I was told by my agent that this was going to be a high-paying permanent position.
We'll see what we can do. Spice it up a little bit, get some fresh takes.
Right. Sounds like an audition, but okay, go.
Yeah, that might be true for this week. We've got a lot going on in the markets again. Obviously, the war in Iran is still waging on and dominating headlines and shifting prices on stocks and commodities, oil, etc. So we're going to hit the recent Iran updates and talk about some oil. We're going to talk about the jobs report that we got last week, not very good, and what that's going to do for the Fed next week, as well as I'm interested. You're a coder. You're an AI guy by nature. Probably not an AI guy by nature, but you're a coder, numbers guy by nature, I should say. And so we're going to talk about the AI arms race, hit on Anthropic and OpenAI, what's going on with them, valuations, etc.
A lot of fun stuff in that space.
Dive into it.
Sure, go.
Awesome. So just to give a quick recap of where we've gotten this week. So Monday, we woke up, all major indices gapped down about 2+%. Oil was up to, I think, 120 it peaked at, just on the escalations in Iran and the significant geopolitical risk from the Strait of Hormuz being closed and possibly, Iran launching missiles at should there be ships going through. And so, we had a tough Monday morning. Turn around pretty quickly. Around lunchtime, a tweet leaked, or the tweet, was written that President Trump said that the war is pretty much done, very close, pretty much. And the S&P rallied. We got all major indices up above their close from Friday, and we had a pretty strong day, all things considered. So first thing I want to ask you, Neil, is do you view this market as pretty fundamentally strong and just the news is shaking prices every other day? Or, it seems like to me that, earnings seasons was really, really good. Scott and I covered that a few times. We had 14% earnings revenue growth in the S&P 500, beat estimates by all things considered. And so it seems to me that we just need some good news to go higher. How do you look at the current state of the market?
I mean, I think if you're talking about the good news in the context of what's happening in the Middle East, to me that's kind of decoupled from market fundamentals. Sure. I mean, we're not talking about, hey, the economy's on good ground, so the minute that it looks like maybe the strait's going to be opened back up or the conflict is dying down, that we're going to rally. To me, all of the short-term volatility that we're seeing now is really about what's going to happen with this specific conflict. And when you have, a Middle Eastern conflict like we're seeing historically, the U.S. we don't have the greatest track record in estimating where Middle Eastern conflicts are going to go, and I think
how long they might take.
Exactly right. Like, in fact, not only do we not have a good reputation of estimating it, I think we historically underestimate just what is involved when you try to get something going in that region. And so I think when you see the short-term vol and President Trump comes on and gives this cryptic tweet, which I guess depending on how you want to read it, you could conclude one or the other thing. But if people view that as some sort of, maybe he's looking for an off-ramp, maybe there's going to be some sort of fairly, resolution to this in the short term, that's what's going to influence everybody. And then you're going to see a lot of that pressure off and the market's going to rally. Is that, lots of times those rallies are just making up for the headline decline.
Sure. Yeah.
So in my mind, I think the economy, is fine. I think kind of underneath the layers here, we've got certainly some inflation, some jobs, things we can talk about. I'm sure we'll get in that a little later, but I don't think that we're in such great shape that any piece of good news rallies. I think it really is limited specifically to this conflict.
Fair enough. It's an interesting point that you make, that the rally is really just making up for the gap down. It's kind of the difference between the intraday movement and the interday movement, where, like I said, Friday closed, Monday morning we gapped down 2%, and in the NASDAQ on Monday we closed up 1%, so a really, really strong day. But as you know, that's a 3.5 intraday trading move, which is pretty wild. I mean, are we in, I feel like since COVID, to use a word you just used, we've been decoupled a little bit, data points, social media, and the market. So we've kind of normalized 2.5-3% moves as being, you know what, that's just what happens when we get a tweet midday, or we get an interview midday, or some good data piece. So do you think that that's new to this recent environment of the world and information traveling fast in social media, or has it always kind of been like this, just in a different form?
Yeah, I mean, I don't think so there's a couple comments there, I guess. Well, certainly from a volatility perspective, I think you will, if you go searching for it, you'll find evidence that the intraday ranges that we're seeing today are higher than they were maybe 10 or 15 years ago. To which I would attribute that largely to just the breadth of information that is available so rapidly.
Mm-hmm.
And, you know, I mean, clearly, if there was a clear message in all of this information and people could just look at it and absorb it, you wouldn't have any volatility. Everybody would do the right thing and the market would go in whatever direction it's supposed to go based on that information. But we know that having all this information at the rapid pace that we see it doesn't mean that people can process it correctly. And as a consequence, I believe that really contributes to those intraday volatility. If you look back 20 years ago, yeah, you'll find 2% days, but the frequency that we're seeing them is definitely higher now.
Interesting. Speaking of volatility, yesterday was the largest intraday drop in oil prices since 2022, basically since Russia invaded Ukraine. Like I said, we gapped up to about 120 on oil prices, or we climbed the ladder to 120, fell back to about $80 a barrel, which was that decline. And now today we had news that there's a few things happening. We have maybe Iran put some mines in the Strait of Hormuz to deter ships from going through. Iran hit 3 UK vessels, and then also we had the IEA come out today and say that they're releasing 400 million barrels to kind of soften the blow of whatever or however long this goes in the Strait of Hormuz with this conflict. So we've had some pretty wild oil moves. How do you look at that as a portfolio manager from a commodity perspective and ownership in a portfolio?
I mean, again, like if the epicenter for energy volatility is the Middle East. So a conflict like this is just going to have a magnification effect that you don't see elsewhere. And so when you think about the energy industry, it's inherently complex, of course. And I'm not an energy expert when you think about understanding all the nuances in the Middle East. But when you have a conflict like this, there's a window of time where you can get things resolved, and then the net impact to the energy is minimal. But every day it ticks on. What are some of the variables that are impacting this now? Well, if you think about the minute Iran kind of said, hey, we're going to no passage through the strait, you have all these producers that have to do something with the oil that they're pumping out, and they can't just shut the wells off. Right. It's not like a faucet. So they have to do something. They load up tankers, they put them in the Gulf, they fill all their storage tanks, and that buys time. The Persian Gulf. And so it buys you some time, but the longer the conflict streams on, now you have these business decisions that, are they shutting wells down? And you shut a well down, which you would have to do if you have no place to put the oil. That has a longer lasting impact, because now, again, you can't just fire these wells back up. So when you consider all those variables, you get this massive volatility in the short term. I'm not an energy trader, but what I would probably do in this case, if I were, is I would step to the sidelines and just let this thing kind of settle down. For sure, if I was making any kind of trade, it's not going to be long or short. It's going to be volatility based. Do something that can play off of that vol piece of it. But it's very difficult, I think, for a portfolio manager, especially one if you're thinking about, it's not your niche to be an energy trader. It's your business to be a retirement planner for clients. Situations like this can definitely wreak a lot of havoc. And sometimes the best thing to do is to just take a pause and not get too caught up in it.
Yeah, and I think if you're an investor, you're probably not looking at trading oil or trading volatility on oil or commodities, but you might be looking and saying, should I own energy stocks? Should I own oil stocks? I think you're probably already too late to that trade. I mean, these things tend to fade out quickly. You and I were just talking about the gas price you paid in 2022 after Russia invaded Ukraine and how astronomical those prices seemed, and now they're down 50%. Only 3 years later, and that was the case shortly after that conflict started in the middle of the summer. So these issues in terms of pricing on oil tend to fade pretty quickly, and it'd be very difficult. We always say it's difficult to time the market. It'd be very difficult to time the market on an energy stock or an oil stock when likely, right, this conflict didn't come out of nowhere. It's been building. Companies that are in energy and oil have been in preparation for another Middle East conflict, which seem to be ongoing all the time.
Yeah,
so
that's right.
you're probably too late to the trade already, I would think.
I would think so. That's why I say taking a step back is probably the way to go, or building some sort of long-term approach, but not reacting to these conflicts when they erupt.
Yeah, you mentioned the impact that an oil increase could have on inflation. We'll get to inflation, or the other side of the Fed's dual mandate, in a second. I want to touch on first. Last Friday we had the non-farm payroll report come out for February. January was a surprise number that we covered. We got that mid-Feb because of the partial shutdown that we had, or that we are having right now. It still is not resolved. We had a surprise upside of about 130 jobs added in January. So you're expecting some momentum. Well, February comes in and kind of poo-poos everyone's parade, and we lost 92,000 jobs. We also had negative revisions per usual to January and December. So it seems like, Neil, we went from a decent labor market, or a strengthening labor market compared to last year, to outright job losses. Is that showing a slowdown, or is this just noise?
So certainly the data points on any given month can be pretty noisy. I think, the labor market's been showing signs of softening for a little while now, due in part because of a lot of this noise that you see. It's the idea of, hey, it's not just a nice steady uptrend. We are getting these downward revisions. And of course, some of them are event driven, like the healthcare strike that we saw that obviously impacted some of the more recent numbers. But from a revision perspective, there are both positive and negative revisions. So I don't think we should
they seem all negative.
Well,
now.
I think to me right now, the way I would read that is that's probably a sign that we're moving into more a weakening of the labor market. Not so much that they always seem to be negative, but the fact that we're seeing these negative revisions, to me, gives me some pause. The BLS survey approach to getting the jobs numbers in general there's a lot of issues with it.
Yeah,
it's hard to get accuracy. There's so many impacts to it. So you kind of have to come to expect and accept some noise in the process. But to me, I would, the continued downward revisions, quite frankly, with the political backdrop that we have right now, which is really President Trump wants to see these jobs numbers always be very rosy. And so, you can only fire the head of the BLS a couple times, and then you got to kind of live with what the data are saying.
Right.
And so I'm not, I'm a little bit paused, a little bit cautious on the labor market for sure.
Okay. So we've got to accept and expect, as you say, some noise in the data. How does a Federal Reserve, expect and accept that noise when they are driving monetary policy based on that? So the other piece of this puzzle is that we had a CPI number come in today. Core CPI still 2.5%. CPI was 2.4%. So again, this theme that we've been harping on for months is inflation has stabilized, but it's stabilized above the t-shirt level, as Scott likes to say, 2% target. So you're still not down to that mandate. So typically when you get a negative jobs report like we had in February, that would be probably an indicator to the Fed that maybe we need to cut rates 25 basis points. But you also have persistent inflation. And I think it was described as a rock in a hard place for the Fed, meaning you've got weakening labor market and also persistent inflation. We've got a Fed meeting next week, and then we have another Fed meeting at the end of April, the last of Jerome Powell's tenure as chairman. So how does I sure he needs to maintain some influence for sure if we're going to have any sense of normalcy in the Fed going forward. But how do they take these data points and that may not be cohesive and transition that into a decision on monetary policy in next week?
Well, if you have conflicting data,
do nothing.
Do nothing. Yeah. Basically, that's
stay out of the way.
That's the summary. I think we have. Obviously, the Fed has all the data that we see. They also have a lot of expertise in analyzing those data. So I give them the benefit of the doubt of having maybe a little more visibility to the intricacies of what's happening
than we do from a report.
For sure. But when you just kind of on that basic level say, hey, job market's not looking that great, inflation's persistent, one of those wants you to cut rates, one wants you to raise rates, you probably are inclined to keep it steady until you really see some compelling evidence that one of those is taking over.
Yeah, and I don't know that we're going to see that that inflation number come down anytime soon. And of course, the longer the war in Iran wages on, oil is going to go up, which is at first going to increase energy, but then it will filter through to basically all aspects of the economy. You'll have that inflation print probably be even higher than 2.4%.
Yeah, I mean, and obviously there's a million ways to measure inflation as well. I think so. There's the baseline quantitative measures that you can pull up and see what the numbers are. And I think second to that is, what is the consumer feeling? And when you think about oil, I mean, when we talk about the inflation rates that the Fed are going to look at, they'll back out oil, they'll back out food prices, right? And get to something that they think is more kind of a stable number, because we know food and energy prices are so volatile. But I think that's not to say they're not relevant, because ultimately, if you have this Middle Eastern crisis continue and the price of oil stays elevated, like you said, that will trickle through. Mm-hmm. We're going from everything, from not just the what we pay at the pump, which is a huge expenditure for most consumers, to fertilizer for your garden. Like just every aspect of it'll start to infiltrate.
Yeah. Yeah, I mean that's a great point. Is coffee incled in that food and oil?
I mean, coffee.
We were talking this morning.
Yeah,
you
as a coffee drinker, I was for me, coffee and gas, they're kind of the same. I'm going to pay whatever I have to pay to fill my tank, and I'm going to pay whatever I have to pay to get my cup of coffee. But I was shocked to see some of the rising cost of the coffee prices that for a typical pound of ground coffee went from like $4, 6 years ago to almost pushing $9 to $10 now.
That's not inflation.
It's definitely,
we don't have 100% inflation.
We don't have that. I mean, obviously tariffs play into that, but it's and of course not necessarily directly driven by the Middle Eastern crisis, but every data point you have where it's hard on the consumer, I think that really is what's going to matter more, because that will then play into what really happens in the economy. These measures that we track are great because they give us some visibility. They're things that we can write down. But when that consumer and the sentiment, I mean, when you think about an economy, the U.S. economy, 70%-ish is the consumer. And so if the consumer's not feeling well because of a Middle Eastern crisis, even if it's not the price of oil, maybe they're just nervous about what does this mean for, like domestic terrorism or whatever unsettling there might be. We want a happy consumer that can afford to get the things they need, and anything that puts that in jeopardy is really what I think underpins what can happen in the economy.
It's an interesting dynamic too, or dichotomy, because we have University of Michigan surveys all the time, every month, that come out and say the consumer the sentiment's basically at all-time lows for the last 6 months or so, and the market's still doing well. The economy's still growing. So it's a weird push and pull. I think there's a lot of consumers that are driven by news and noise and politics that are going on.
Information flow we were talking about.
For sure. So from to wrap up on this topic, from a portfolio manager's perspective, when you get we've got a handful of portfolios that we run that you and Scott build based on economic data prints. And one of the factors in those data points that we consume is the unemployment data. And so when you've got like a temporary shock, like you mentioned, the healthcare strike going on in California, that the report said was attributable to 31,000 of the jobs lost because they're striking. How are you able to filter out that noise in your portfolio construction? How does that work so that you're not getting whipsawed based off of these super temporary factors? Right.
So for sure, if you're reading the headline number, you are likely to get whipsawed. I mean, there's no way around it. In our strategies, like the ones you mentioned specifically that are based on the economic model that we put together, there's a natural filtration in that process. By natural, I mean we've built the model to kind of incorporate trends over being overly influenced by a single data point. So that part of it works into it. It's not completely immune. You get enough of these shocks kind of spaced at the right interval, and we'll see that even in our own models. But in general, when we create a model like the economic model that we use behind several of the portfolios, is really designed to kind of smooth some of that out.
Yeah.
And then read the headline for entertainment's sake.
Yeah. And headlines and entertainment's sake are abundant right now and galore, especially when we talk about the AI space and AI companies. We're sort of in this like friendly AI arms race between OpenAI and Anthropic right now. Last week there was this whole situation where Anthropic was negotiating terms with the U.S. government. Palantir has used Claude in some of the recent missions in Venezuela. It was said that it was used in Epic Fury as well in Iran. So certainly using AI to assist in some of these military operations. Anthropic came out and said, we want to do a deal with the government, but cannot be used for mass surveillance and cannot be used to be a killing machine, basically. And Sam Altman of OpenAI came out that night and said, we stand with Anthropic. And then by the time I woke up, OpenAI had a $200 million deal with the government, and Anthropic was labeled a supply chain risk. Is that what it is?
Yeah, supply chain risk. Yeah.
So a lot of stuff going on right now in the AI space. And then also the valuations on these companies are mouthwatering, really. I mean, OpenAI is up around $850 billion after a recent $110 billion round of funding, and Anthropic's at $380 billion after a $30 billion round of funding. So, are these valuations worrisome to you? Do they remind you of the .com bubble? How do you kind of digest what these companies look like and if they may go public?
I mean, a lot to unpack there.
Yeah, sorry.
I think,
one question for about 2 minutes of AI
whole topic.
news.
So I think like AI for me as a technology and as a space is it's exciting and scary all at the same time. And I think let's step back to Anthropic for a second. And like when you think about it, there's a lot of credibility to the argument that says, subcontractors to the government shouldn't be able to dictate what the government's going to do. And so, you would see that you get Raytheon that makes a missile. They don't get to tell the government which targets they can use that missile on, which they can't. So that makes sense, except in this case with AI, we're dealing with consequences that we don't really know what they are yet. Like this is a kind of blooming technology that offers a lot of promise, but also comes with a lot of risk. And there's a whole side of it of the, what are the unknowns. And so in some ways, I think Anthropic's request of, if you view it from the lens of, hey, we just want guardrails on this technology, maybe because we don't really know how it might react to some of these situations. To me, that seems prudent right now until the technology has developed itself further and we can understand maybe where some of those risks lie. I do find it odd that I feel like OpenAI had that same mentality, but now they step in and take the government contract. So that's there's probably a lot going on behind the scenes there that we don't know about and never will know about. It makes the optics look a little weird to somebody like me, but that will work however it works. Hopefully it works out favorably. The valuations, man, they're not mouth-watering. They're mind-numbing, in my opinion. Like I can't even put my head around $1 trillion valuation on a company, which is where OpenAI would be forecasted to be if it ever went public. And that seems insane. And I don't really have anything else to say. Yeah. That's insane.
Yeah.
So, what does it? Okay, I do have some more to say.
Yeah.
But
go ahead.
Is there really $850 billion worth of value there?
I mean, that's the debate right now. So, they're private companies. So the publishing of their data and revenues and all that good stuff is not, it's not GAAP audited. So by no means is it the same as NVIDIA coming out and sharing their earnings report.
Absolutely.
But you had the CFO of OpenAI come out and say they did $20 billion in revenue last year. Anthropic said they did $9 billion in revenue last year after $3 billion the year before. So their run rate's ticking up. That puts, given the valuations that I said earlier and those revenues from last year, that puts them both at about like 42 times price to sales, which I know is a metric you like to look at when you're looking at tech companies. For reference, NVIDIA is at about 22 to 1 right now. Palantir's at 86 to 1 though. So people are clearly buying what Palantir's got to sell, and that's at double what the price to sales are. Now you could argue that, these are like I said, private companies. Who knows if the revenues are the revenues and which streams that they're coming from within the company lines, but they're not as ridiculous and nebulous as they were a year ago when OpenAI had like $2 billion of revenue and we're picking up $100 billion deals left and right with tech companies.
Yeah, I mean, okay. So we talk about, yes, they are private companies. And so as a consequence of that, there's a level of transparency that we don't have. So first question, is that $20 billion in revenue, is it real? What is it tied to?
Right.
Is it some creative accounting that's not, that technically is not illegal, wrong, but it's creative.
Yeah.
And so until, another way to think about the question would be if OpenAI went public tomorrow and at an $850 billion valuation, where would the stock be 6 months later?
Yeah.
My guess is lower.
Yeah.
So how much lower? I don't know. Gets back to when you compare it to some of the public companies, the public AI winners. We don't see it there, but so again, motivates me to think that we would end up with a kind of an IPO hype that ultimately settles down to something that's more tangible, more real. Maybe it's still higher than 30 or 30x, but something that at least at that point can be more openly justified. And we'll see. Now, you talk about mentioning this. How does it, are there parallels to this with the .com bubble? I think there are. There's some parallels dealing with new technology, but more to the point, I think dealing with a lot of, I don't like to say hype.
Yeah.
But it's really hype.
Yeah.
It's promises.
Right.
Promises of what this technology will deliver. That's very equivalent to what we were seeing back in the .com days. Although I would say this is like .com on steroids, because AI can solve every problem ever known and every problem that's not even known, and that's going to be the greatest thing ever. I don't have that vibe. I didn't get that vibe back in the .com. I know that was .com was pre Jake, but
pre-consciousness for sure.
So, but I think that's when you step back kind of on the emotional front, it's really that. It's like, will these companies deliver on their promises of what they can do with this technology? You and I were in an engagement, I don't know, a few months ago, and that was one of the points I was
just
making.
about to bring it up.
That I think is important, which is if you want to get into this space, try to see if you can separate out the hype. Part of the reason NVIDIA is doing so well is because it's got hardware,
right?
And it's like delivering a product,
right?
And now, some of the companies buying their product, just stacking it, waiting for future expansion, and we'll see where that goes. But in as long as NVIDIA doesn't get creative on, hey, pay me later, I'll pay you on Monday for a hamburger today.
I mean, they look sort of circular, but not to the same extent as they were previously.
Right, and that's where when you're kind of crossing that public to private line, that's where some of this stuff can kind of get shaded.
Yeah.
And then when everybody's public, you kind of see some of that. But in general, I like the space, and I think if you can stay kind of in that tangible realm right now, don't get too caught up in as soon as they hit this LLM milestone, our company's going to be great because we're going to deliver this. That's the stuff you want to kind of avoid.
Yeah.
I think.
I like that IPO hype, because that's what we've seen kind of in the last 3-4 years with SPACs that were really hot coming out of COVID, is that these companies that get all of these IPO hypes, and we've seen only larger and larger IPO valuations, obviously as companies are generating more and everything's worth more now. But those companies do in the first 6 months or 9 months tend to drop relative to their IPO price. I totally forgot to bring this, and it was on my list to remember, but my dad was cleaning out his house the other day and found the 2000 Times Magazine Y2K edition. And so to add an anecdote to my my pre-consciousness sort of time frame, there was a 3-page ad in that magazine for Compaq.
Right.
Which was the largest computer seller at the time.
Oh, yeah.
And part of their ad was that at some point, I think it was like a letter to the people in 2100, the year 2100, that they'd be having computers in their hands, like a laptop in their hands. So I didn't even know what Compaq was. I think it's still publicly traded, so they still do something.
So I think they're still the brand. They were, so back in the day it was like Compaq and Dell. Like those are kind of competing brands. Dell won out. I think Compaq was bought by Hewlett Packard, I believe.
Okay.
And I thought Hewlett Packard closed the brand down. But they might have had, I think in some pockets around the world, maybe you can still find the Compaq brand. But for the most part, I associate Compaq with Hewlett Packard now. HP.
Okay.
Yeah.
It's not currently sold. So that makes sense.
Yeah.
That makes sense. So
I mean, how pretty good call back saying,
for sure.
In
I mean,
2100, you're going to have,
70, 80 years late, but
yeah, well,
I mean, I think the other thing that everybody always references is like the late 90s, early 2000s, people thought we'd be in flying cars and teleporting and we'd be back on the moon and if not Mars, and none of that's happened yet. So,
well, that we know,
that's true.
you can get we're starting to see already, autonomous drone taxis. So kind of like your personal helicopter. NASA is talking about going back to the moon. Funding cuts are going to prevent that, but not the desire or the technology. So now all this stuff sounds crazy, but there's a lot of it that rings at least true on a couple notes.
Yeah. When you were saying autonomous drone, that's not where I thought you were going to be going, but that's a better route than what I was thinking.
Even just the word drone right now maybe is four-letter word, but
yeah. So I know something that could drone out some of the bad news, at least for us sports fans. We have turned the calendar, I said this last week, to March. Right now, we're looking at the pit right now, and these guys have Bloomberg on one screen and the start of the conference tournaments on the other. Favorite memories from March Madness, Pep? What do you got? And you're a Michigan man. I'll intro that for you. So
we have to intro it. Here we go.
Didn't even need to intro it. Beautiful.
So, you know what? I've got pretty much a love.
It's nice to have another real national championship school.
That's right. No, yeah, of course. Yes. I got to say, when it comes to the tourney, I got a kind of a love-hate relationship with Michigan in the bracket. I mean, in my lifetime, I've seen them lose 4 times in the championship game. I think 4. Yeah.
So Villanova was the most recent.
Well, it was the Fab Five back-to-back years.
Yep.
And then I think maybe 2013, 2018. So
13, yeah. 18 would have been to the Villanova team.
Yeah.
I think that was Trey Burke.
Yeah.
Or I don't know if Trey Burke was 2018 or 2013, but that was my buddy Jalen's team. So
all right. So, I mean, I'm excited for.
Yeah.
Frankly, I actually probably watch more basketball this season than I usually. I wait till March and then I get into it because that's when everything really matters anyway.
Yeah.
But Michigan has been a lot of fun to watch this year. Plus, my son goes to Wisconsin, so even that loss was kind of fun to watch because he was pretty thrilled to see Wisconsin beat Michigan at home, which is I don't know how that happened, but I think Michigan has a good shot. I'm excited to watch the tournament.
Okay.
But given my history, I gotta take it with a grain of salt and be prepared.
So last week I gave Michigan as my pick. I think Florida's my second option. The guy to my right, Scotty, said Duke. Where do you land? Are you giving a homer pick or you got someone else?
I like Duke, but I like Duke. Look, I can't go on the record for going against Michigan. So go blue.
Well, you are on the record right now.
No, I'm saying that's why.
Okay.
I'm saying I still
that
go with Michigan right here.
Computer.
Let's do this right here.
Put it right there.
I think I gotta tell you this. I would love to see a Duke Michigan championship.
Awesome.
And then a blue win on that, as kind of a payback.
A blue win. Are you being funny because they're both blue?
I mean
they're the Blue Devils. So
that doesn't count. Go blue.
So you want Michigan to win?
I want Michigan to win.
Okay.
I want Michigan to win, and I'd like to see him beat Duke in the final.
All right. Very cool. I mean, it's going to be an awesome, these 3 weeks are always awesome. This season's been amazing. There's been so many upsets. Wisconsin has 3 of the biggest wins this season and probably 3 of the biggest losses this season.
That's the funny, Wisconsin, they're a funny team to watch this season, right? I mean, we again have a son there, so it's I have a vested interest, but how can you have those wins and those losses?
Yeah.
It's just perplexing.
Night.
Yeah, I guess.
Any given night, my Hoosiers take on Northwestern tonight, and probably a do or die game for their tournament hopes. I think if they lose, they're probably firmly on the wrong side of the bubble. So we'll see. We've got football.
We're a football team now.
School.
Yeah, of course. You don't care about basketball anymore in Indiana.
No, we're a football school.
Right.
Pep, let's wrap it up with our fades or trades for the week. So I'll give these to you first. You give whether you're going to fade or trade it, and then why, and then I'll rebound as well. First fade or trade of the week. March jobs reports will be negative. It says surprise to the downside, but will be negative coming off the back of the February reports.
All right, so I wanted to comment on surprise to the downside
because
that's I think an element to this, because when you think about, even if we just look back at the most recent report, the February report, where we were expecting I think plus 50,000 or 53,000, we get a negative print. One of the things I would say is why do we think the 53,000 estimate was any good, right? So we know that economists are horrible at trying to forecast where the jobs, they're never, the amount of time that they're right is a very low percentage. Not just in it'd be difficult to call a number to the exact 1,000, but just how often they can be wrong. So that was going to be my comment to the surprise to the downside. But I think I think we do probably see a negative print in March.
Okay.
Yep.
So you're trading that it'll be negative.
It would be, yeah.
All right. I'm going to fade it.
Okay.
I'm going to fade it. I think, to your point, we had a 50,000 job growth expectation in February. Obviously, we didn't get that. We talked about some of the temporary factors that were involved in that. You say economists typically aren't able to predict it. I think directionally they're typically right. Magnitude, maybe they're not. So I'm going to say that we do get a positive print in March. This is actually something I just thought of this second, and I don't know if this is true or not. You could tell me, but would the struck jobs, if they are back, if they're back working, would that be a positive job gain?
So like I was just going to put that caveat on it because I
trade it.
The one thing that would
I fade it. Sorry.
So those jobs coming back online could impact it positively. Yeah. So I'm still going to go with a negative print because I said it, but I had the same thought as you did kind of after the fact. So that'll be an impact.
Yeah, that'll be interesting. Second fader trade of the week. We've got Jerome Powell, as we mentioned, with 2 Fed meetings left before his chairmanship is over. We mentioned the conflicting data for their dual mandate that we got in this past couple weeks. Fed cuts rates in the next 2 meetings. Do you fade or trade that?
I don't think it happens.
So fade it.
So yeah, fade that.
Yeah. Okay. No explanation needed.
I mean, look, I think, again,
I don't have anything to say.
What are the two driving things we talked about on inflation and jobs?
Yeah.
I think there's a greater risk at this moment in time that the Middle Eastern conflict in particular, plus the kind of, we admitted earlier, we have some lingering inflation. And then now all these global events are only going to support that. So I think it's going to come down to the pressure's probably going to be more on the inflation side, having the, kind of like motivating the Fed to do nothing.
Yeah.
Because they obviously don't want to take the chance on the job market, but so I think they stay flat.
Yeah, I'm gonna fade that as well. I don't think, similar to what I said a couple weeks ago, I don't think we fade in the next 2 meetings. I think we actually stay put until the back half of the year, which I think Scott called me crazy for, given that we'll have a new chairman that is more than likely going to be at least taking or having Trump's ear a little more than Powell does in this term.
Sure.
Third fader trade, your team. So you're a Michigan, as I said, Michigan guy, Detroit guy. The Tigers, really good season last year, faded at the end of the year, which was really weird.
Yeah, it was weird.
But will they go over their 85.5 win projection?
Yeah, I'm going with that one. We got Verlander back. I'm trading it. Yeah, this is going to be an exciting year for the Tigers.
Yeah. I'll trade that as well. It's an exceptionally weak AL Central as it typically tends to be, but the Tigers are extremely exciting. I mean, they were 2 years ago, they were a year early. So last year they took a step back a little bit.
Yeah, last year their timing was just bad in the it's like the worst time to fade. Yeah.
So I think you got to learn how to win. I think they're gonna. I like the Verlander edition, if nothing else, just for the veteran in the room. Skubal is a bona fide perennial hoss. I think they will win the AL Central, and I think they'll be a factor in the playoffs. It's tough because I think the World Series is just the Dodgers to lose, and then we'll have no baseball in 2027.
There's so much parity in baseball anyway. It's like any given year, but I feel good with the Tigers.
This fourth one here, and this is our last one because we had a random ticker roll, but as you guys can see, the ticker is off back there. So let's wrap up with this one. Neil, the 2026.9 grape harvest. Are you fading or trading it?
So
what is 0.9?
So 0.9, since nobody knows what 0.9 is, it's a private label for my private label. Started a vineyard a couple of years ago. We're going into our third growing season. In the first couple of years, you drop the fruit, so you don't have a crop. Third year's kind of you can have something. By year 4, you're usually in full production. So I'm feeling really, I should say I was feeling really good about it. Last night we had a bunch of really freaky weather hit the Midwest.
The hail was insane. It was huge.
The good news is we're not in the growing season yet, and I don't think we actually got a hailstorm up in Leelanau Peninsula in Michigan where the vineyard's located, but I don't have an on-the-ground report yet. So assuming we dodge the weather, I'm feeling really good about it. We're going to see. We'll have, again, we won't be in full production. We'll have something to play with. I'll make some wine in the fall, and we'll drink it a year later, and we'll decide how it turned out.
Love it. I'm trading the hell out of that. A year from now, I've tasted a couple bottles. Delicious. Obviously, these are your new grapes now. So I'm trading the harvest. How can I fade my guy's harvest here?
No. And I mean, even if the harvest doesn't provide, just wait another year. Yeah. So we're good. Yeah.
Awesome. Well, Neil, appreciate you stepping in today. We'll see what the viewers and listeners say for your audition, and that might determine how often you'll be back.
That's right. All right.
Thanks, everyone. We'll see. Vote for Pep, and we'll see you next week.
All right.